All right, so a little bit of overlap on the last video. I kind of started on the research and development, but I'm going to come back here just so we make sure, in case this video was watched independently of from the one before it. Okay, so US has a rule that all R&D gets expensed as it is incurred. So this is why, pharmaceutical companies may charge a lot for a new drug, and that's because they may have been spending research and development for 20 years trying to make this drug that may, do something, just whatever kind of drug. So I know a lot of people have a lot of opinions about the pharmaceuticals, but they are the ones doing the research and development and they're not getting to capitalize it. So a lot of times when they start to be able to make money from it, they are more expensive. Okay. So um, so determining what R&D costs are. So some of those things include salaries, wages, other labor cost of R&D, cost of materials consumed, equipment, and there might be an intangible. There may be a patent that you've bought to be able to use to do the research and development. Okay. If an asset is purchased for a single R&D project, we are going to expense it immediately in the current year. If it has alternative use, then we'll depreciate it or amortize a patent. Okay. So I am going to jump on down here to this example. I thought this was really good. This is an example of showing kind of how much money could go into R&D expense. Okay. So they have salaries, supplies, um, payments to others for services in connection with the R&D activities. Okay. Notice they don't have circled the $5 million equipment or the patent. Okay. So those are going to go in a little bit different area. I think they tell us that the R&D equipment is going to be used for so long. I'm not sure. Maybe it was here on the next slide. Okay. So those three together equals up 14,200,000. So that just goes straight to R&D expense, credit cash. All right. Now we're going to look at the R&D for the equipment. Okay. So for the equipment, they are going to debit the equipment and credit cash because they can use it. I think they said this was equipment they were only going to use. Okay, it says right here, the equipment purchased will be employed in other projects. So the depreciation on the equipment for 2027 is 500,000. Looks like it may be going to be a useful life of 10 years. Okay. So they're going to record that as equipment and credit cash. Okay. It doesn't get dumped all into research and development because it's going to be used for other projects. Okay. If it was only going to be used for this project, and we might anticipate we're going to be on this project for 5 years, then we could also depreciate it gradually over that going to R&D expense. Okay. So then we have the accumulated depreciation. Remember, we have that accumulated depreciation. That's the contra asset that goes with the equipment. But when we expensive, no, realize it does not say depreciation expense. It says R&D expense. Okay. And then the $100,000, they actually get to put $100,000 on the patent account, and that's it. Out of almost $20 million, the only thing they get to put into an asset is a patent. Okay. That's why a lot of new drugs are more expensive. Okay. Because they're trying to recover all of this. Okay. They're trying to recover all of that. It really doesn't relate to this patent because they spent a whole lot of money and there's no telling how many years they, you know, did this trying to get up to that. That's just this year. Okay. All right. So they kind of give us a few things here. Um, R&D expense, capitalized equipment, and capitalized as a patent. Okay. Moving right along. Um, IFRS is a little bit different than US GAAP in this. For research expenditures are expensed in the period as incurred. However, development expenditures that meet specified criteria are allowed to be capitalized as an intangible asset. I don't really have opinion which one of these is the better way. it's just really hard to make journal entries with unknowns because you just never know. You might be spending $20 million on a project that's gonna do nothing and you don't get anything out of it. And then therefore, you might spend $100,000 on something and you make a lot of profit. So it's really hard to match. And that's what we try to do in accounting is match revenues and expenses. In these cases, it's very hard to predict the future. So it's very hard to be able to apply these rules consistently. Okay. I don't know which one's better. I mean, they're both different. I don't know that either one by itself is good. But also, I don't know what in between, which one of these would work better. I don't know what would work better because, again, we don't have a crystal ball and we do not know what the future holds. Okay. So, moving right along. All right. Software development, that's also one of those things. It's going to be expensed as incurred until that technological feasibility, and then we can start capitalizing cost at that point. Okay. Then cloud computing costs. This could fall underneath as an intangible. Cloud computing could, because almost everybody saves things in the cloud. I might have some files on my computer, but everything I have is backed up to my OneDrive in the cloud. And somebody was asking me about my computer running slow one day, and they were like, "How much stuff do you have on there?" I was like, "I don't save anything to my computer. Like it's all in the cloud." So that's not really it. Could be the network running slow, just the computer getting old itself. Okay. I've had one too many computers like die on me, and then I didn't have a backup for my files. So I have learned don't ever save it on the computer. Okay. Now, what if we have R&D that we are being hired to do R&D for another company? So we're basically doing a job and we're going to get paid for a job. So yes, therefore we can inventory that because we're going to get paid for that. We're just getting paid to do R&D for someone else. They're going to pay us, okay? So we can inventory that and then it'll kind of move to cost of goods sold just like, your inventory or when we're in a manufacturing business, that could happen there too, okay? All right. We could acquire R&D could be purchased in a business acquisition, and you'll find this a lot of times. Businesses will want to acquire other businesses just because they're technology. They may have developed some in-house technology that is really awesome, and they're going to acquire the whole company so they can get their hands on that technology. That's where goodwill comes up. Okay. Now, we're going to talk about startup costs. This happens at the beginning of the process to incorporate. So, organization costs, there's a lot of legal fees, state filing fees. This is when they have the IP initial public offer, IPO. Okay. And sometimes those organizational costs might be we might get those paid for by maybe the company that's doing it for us. Maybe instead of being paid money, they may want some shares of stock, and we can do that too, but that would still be expenses no matter if we paid for them or we issued stock for them, it is still an expense. Okay. And those have to be expensed in the year that all the costs are related to the organization and its startup cost. Okay. I thought this was interesting because I know a tiny bit about oil and gas, my property in Louisiana. I do have all the mineral rights to that. I know there is natural gas all over the place. They're just not doing any domestic drilling at this point. It'd be nice if they did because I might get some oil and gas royalties off of that. But they have two methods here. They have the successful efforts method, and this just means any discovery or any time that you go through one of these exploration costs and it doesn't result in the discovery, then it's expensed as incurred. Okay. Full cost method, this is where when you have gone through the exploration process and you know it's there and you have a successful well, then you're going to keep all the cost up to date on that. Okay. And probably amortize it out over the life of the drilling there. Okay. They have a problem here on oil and gas. I'm not going to go over that. We have another concept check, and we are done with chapter 10. Yay! I will see y'all in chapter 11.